Say you've got $500. It's not your rent money, it's capital you're ready and willing to put into the market. And you've got a feeling, a real conviction. You've been watching the markets, you've done the reading, and you're just convinced Bitcoin is on the verge of a huge breakout. So what's the most obvious move? Well, you take your $500 and you buy $500 worth of Bitcoin. Done. It's simple, it's direct, and now you officially own a piece of it. And guess what? You were right. The price pops 20%. Your $500 investment is now worth $600. Hey, you just made a $100 profit. And look, $100 is $100. That's a great return. But let's be real, it's not exactly life-changing money, is it? And that's really the limit when you're making a small, direct investment. Now, this is where things get really interesting. This is where the pros start to think differently. They look at this exact same situation and they don't just buy the asset. No, they think about how to structure their exposure to it. And that word right there, structure, that is the key to this whole thing. So what's their secret weapon? It's a tool called a call option. It lets them bet on the very same idea, that Bitcoin is going up, but it does it in a way that just completely rewrites the rules of the game. So what on earth is a call option? Just think of it like this. You're buying the right to profit if an asset's price goes up, but you don't actually have to own the asset itself. You're not buying the coin. You're buying a piece of paper that's tied to how the coin performs. This is the concept you've got to wrap your head around. You're shifting from owning the thing to owning the potential of the thing. It sounds like a small change in words, but believe me, it is an incredibly powerful shift in strategy.
Okay, so let's break down how this works in practice. First, instead of dropping your whole $500 on Bitcoin, you pay a much smaller fee to buy the option contract. That fee is called the premium. Next, you pick a strike price. That's the price you're betting Bitcoin will soar past. If you're right and Bitcoin blows past that strike price, the value of your option contract can explode. Since you paid way less for that contract up front, your percentage return can be massively higher than if you had just bought Bitcoin directly.
And this little table here just lays it all out. Both strategies start with the same $500. Buying directly, you own it, and your gain is proportional, 1-to-1. But buying a call option, that gives you what's called leveraged gain. It means a pretty small move in Bitcoin's price can cause a huge percentage gain for your option. That's the allure. But, and this is a big but, look at that last line. The maximum risk is exactly the same. You can still lose the entire $500. You hear that, leveraged gains, but with a defined risk. And it starts to sound a little too good to be true, right? And that's exactly the question you should be asking. So what's the catch? Here it is. 2 simple words. Options expire. Unlike owning actual Bitcoin, which you can hold on to forever if you want, that little contract you bought has a ticking clock on it. And this, right here, is the big trade-off. Every single option has an expiration date, and if Bitcoin doesn't get above your strike price before that date hits, your option can become totally worthless. Poof! Your entire premium, gone. And this is the painful part. You could be 100% right that Bitcoin is going up, but if you're wrong about when it's going to happen, you can still lose all of your money. Which brings us right back to where we started. With a tool this powerful, but also this risky, you can't just dive in. You have to understand the structure, the strike price you choose, the expiration date, how much you pay for the premium. Getting that right is absolutely everything. So the real takeaway here is a question. The next time you feel that strong conviction about where the market is headed, ask yourself, am I just going to be a buyer, or am I going to think like a pro? Am I just buying an asset, or am I going to get smart and structure my risk?